Hi guys, in today's video we're going to discuss the chapter 5 of The Intelligent Investor. In chapter 5, Benjamin Graham discusses the common stock strategy for the defensive investor. As we will see in this video, the selection of common stocks for the portfolio of the defensive investor should be a quite simple matter. In particular, Benjamin Graham believes that the defensive investor strategy should be centered around 4 rules. Rule number 1, diversification. So there should be some diversification, although Benjamin Graham believes that there should not be excessive diversification. Number 2, the companies should be large, prominent, and conservatively financed. What this means, in simple terms, is that a company should have at least 10 billion in market cap, should be ranked in the first, fourth, or third of its industry, and should be financed with at least 50% by common stocks. For railroad and public utility companies, the total capitalization should be at least 30% out of common stock. The third rule discussed by Benjamin Graham regards dividends. So there should be a long record of continuous dividend payment. What this means, in simple terms, is that today's defensive investor should probably insist on at least 10 years of dividend payment without any interruption. Number 4, a trading PE ratio over the last 7 years. Generally, when we refer to trading PE ratio, we refer to the PE ratio where the earnings are the average earnings over the last year. Benjamin Graham thinks that you should consider a PE ratio with earnings over the last 7 years. In particular, Benjamin Graham suggests that the defensive investor should limit at 25 times such average earnings over the last 7 years and 20 times those of the last 12-month period. However, such a restriction would eliminate basically all most popular companies from the defensive investor's portfolio. To be more specific, such a criterion would eliminate all growth stocks from the defensive investor's portfolio. Therefore, Benjamin Graham decides to discuss a little bit more on why including the fourth rule within the defensive investor strategy. So first, let's give a definition of what a growth stock is. A growth stock is a company which has increased its per share earnings over the past years way above the rate of common stocks and is expected to continue to do so in the future. So, of course, everyone wants this kind of stocks in his or her portfolio. However, the problem, according to Benjamin Graham, is that they are generally traded at high prices. Because everyone wants this kind of stocks, the price is generally inflated. And as a consequence, these kind of investments are too speculative for the defensive investor. That's why, in discussing the defensive investor strategy, Benjamin Graham suggests to refrain from investing in growth stocks. Now let's move on to another concept that is discussed in the chapter 5 of The Intelligent Investor. Dollar cost averaging. So dollar cost averaging can be defined as a strategy where an investor devotes the same dollar amount periodically to buying one or more securities, such as stocks. This investment strategy prevents the investor from concentrating all his purchases at the wrong times. Benjamin Graham admits that this kind of strategy is sound in principle, but is rather unrealistic in practice because few people are so situated that they can invest the same dollar amount periodically for a very long time. This means that even though this strategy has been proved successful, few people have actually applied this strategy consistently for a long period of time. Alright, thank you for watching this key chapter of The Intelligent Investor. If you want to purchase the book, I'm gonna drop a link in the description below, and don't forget to subscribe if you liked the video and watch my other videos about finance. Thank you for watching, and bye everyone.